So I'll go ahead and get started. And I wanted to start just by sharing a little bit about Murphy. So Murphy Business Sales is a company that was started by an accountant named Roger Murphy. It was started as a single office in Clearwater, Florida in 1994, so a little over 30 years ago. Murphy now operates across the US and Canada, and we're involved in roughly 300 business sales per year. The total value of businesses that have been sold by Murphy since inception exceeds $4.5 billion. So the size and scope of Murphy now gives us a lot of insight into what investors are looking for and the factors that drive successful business sales. Now, at the risk of stating the obvious, the main thing that investors are looking for are profits. If you read the Wall Street Journal or if you watch CNBC, you read about and you hear about lots of unprofitable companies that are acquired because they have innovative new products, and larger companies want to integrate those innovative new products into their portfolio. They want to enhance their existing offerings. When we're talking about the sale of Main Street businesses or lower middle market businesses, that's not what we see. We see investors looking for profits. And when we're talking about Main Street businesses in particular, here in New York and Connecticut, we see lots of people that are sick of their jobs, sick of working on Wall Street, or sick of working for large corporates, and they're looking to buy a business so that they can become owner-operators, and they need that business to replace the income that they were generating from their job. We also see a lot of people that want to become absentee owners, people that want to buy a laundromat, a liquor store, or a car wash, and they don't want to be present. They want that business to be managed, but they want that business to generate additional income for them and help them to diversify their existing income streams. So these investors are also looking for profits. And the third point I want to make about profitability that I think is really important is that profitability enables the buyer to take out a loan to acquire the business. These SBA lenders, SBA-backed lenders, they're willing to finance a purchase of a business, but the only way for them to really value a business that doesn't have hard assets is to value that profit stream. So that's a third reason that investors are looking for profits when they're thinking about buying a business. Now, we also get great insights into what investors are cautious of, what they're looking to avoid. And I think the main thing that investors are nervous about when they're thinking about buying a business is dependence on one key employee. If you have a business that was started by one person, and that person is the one that answers the phone, that person is the one that provides the sales estimates, and that person is the one that does the work, there's a lot of dependence on that key employee. And a new business owner is worried that when they acquire the business, a lot of the customers will go away because they're used to working with the previous owner. Investors are also nervous about customer concentration. They're nervous about buying a business that's reliant on one customer or a few key customers for most of their revenues. And then I think the third thing that we see a lot of in terms of investor concern or investor caution is concern about economic sensitivity. And this is especially the case if you have an investor that's taking out a loan to buy a business, is going to need to repay that loan over the next 10 years. If they see economic sensitivity, if they see a business whose profits and sales are likely to decline with a change in economic conditions, they're going to be nervous about taking out that loan and about buying the business. So again, the three things that we see that investors are nervous about are employee dependence, customer concentration, and economic sensitivity. Now, one sobering statistic that I want to share with you is that of small businesses that are listed, only 20 to 30% of them will sell. Now, the main reasons for this, the first reason we talked about already is owner dependence. The second reason why a lot of businesses will not sell is poor record keeping. If the books aren't clean, if it's hard to verify that the business actually generates the profits that the seller says it does, you'll see a reticence to make an offer. And the third reason why a lot of small businesses don't sell are unrealistic price expectations. And I'll share a couple stories about this. One of the Murphy brokers that's based in Missouri had a customer that said, listen, I have $800,000 of debt. So if I can sell this business for $1 million, I'll take it. I'll sell. Another colleague of mine, a broker in California, had a client that said, listen, I need $3 million to retire. So let's list the business for $3 million. Someone that I spoke to last year said, my competitor has the same sales as me, and they just sold their business for $4 million. So that's what I want to get for mine. So we can break down these comments, and hopefully it was clear from the example from my colleague in Missouri and the example from my colleague in California, when they were talking about the debt that they had or how much money that they need to retire. These numbers have nothing to do with the business, with the sales that the business generates and the profits that the business generates. So these are not good ways to value a business. Now, the comment that I heard from a business owner who said, my competitor had the same sales as me. They sold for $4 million. That's what I want to get. Now, at least we're talking about the business fundamentals and using the business fundamentals to value the business. However, as I indicated earlier, investors are more concerned with profits than with sales. And I want to share a slide which will hopefully provide a useful illustration here. So these are some numbers for businesses in the residential remodeling business. I had a business owner come to me last year, and he had a remodeling business that generated about $1 million in annual sales. And so we looked at companies in that space that had sales between $500,000 and $2 million that were recently sold, and we plotted them. We plotted them against revenue, we plotted them against EBITDA, and we plotted them against SDE. And just by looking at the charts, you can see that revenue is a pretty useful indicator. Most of these businesses sold for a number that kind of made sense in relation to revenue. But you can see that the dots are a lot more closely aligned to these profit measures, to EBITDA and to SDE. And when you look at the correlations here, you can see a much higher correlation between sale price and EBITDA and sale price and SDE. So when we're valuing a business, we will focus on those profit metrics. We will analyze the business. We will look at the last 3 years' financials and calculate these profit measures, excluding one-time items, excluding non-cash expenses, to get a clean measure of pre-tax cash flow. And then we will look at the multiples at which similar businesses sold on those pre-tax cash flow measures to value the business that we're listing. Now, a lot of business owners that are thinking of hiring a broker are also thinking about managing the sale process themselves. So I want to share a few bullet points as to why it makes sense for a business owner to hire a broker to help them with the sale process. A broker, as we just analyzed, can help the business owner with the business valuation. A business broker can help to develop a marketing strategy and marketing documents. A business broker can handle inquiries from serious buyers as well as from tire kickers that are just looking for information and have no real interest in acquiring the business. And the business broker can help to preserve confidentiality throughout the sale process. It's extremely important that customers of the business and employees of the business only find out about the sale late in the process, right when it's about to occur, or even after the closing has taken place. When the business owner is managing the sale process themselves, it's really easy for customers and employees to find out, since the business owner is the one that's fielding phone calls. And lastly, I think the other value that a business broker provides is a business broker allows the owner to stay focused on running the business. Now, why is this important? The sale process usually takes 9 to 12 months. And when the price is agreed to, the price that's agreed upon is based on a certain level of profitability. If a business owner is distracted by the sale process, is spending a lot of time talking to these tire kickers, negotiating with buyers, conducting buyer and seller meetings, touring their facilities with interested parties, the business may suffer. And if the business suffers, the buyer is going to want to renegotiate and is going to want to make a lower offer for that same business. Now, how does Murphy stand out relative to other business brokers? To give you a sense of the industry as a whole, as I mentioned, only about 20 to 30% of businesses that are listed get sold. And in 2024, that was on the lower end. It was about 20% of listings actually making it to the closing table. The average time on market was about 12 months, and the average deal value was $250,000. On all those metrics, Murphy outperformed. So Murphy closed a higher percentage of listings. Murphy listings spent less time on the market. And as a result, Murphy brokers were getting higher value listings.